In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about why the Indian rupee is constantly falling and why this matters for people like you and me. In the second one, I'll discuss how the Indian government is looking to help shipping companies with insurance now. And in the third and final story of the day, I'll discuss TCS's latest quarterly results and bring out some key takeaways from it. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news in the financial markets for you in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 14th of October. The rupee recently hit a historic low. Now you need 84 Indian rupees to buy $1. And this is a big deal because it is the first time the rupee has depreciated so much. Now the thing is, rupee appreciation as well as depreciation are usually discussed in the news very often, but many of us still find them very confusing. So in this story today, let me simplify all of this for you, explain what is exactly going on here and why it also matters to you and me as investors. To start with the basics, prices, whether for goods, services or currencies, depend on simple demand and supply. If demand is high but supply is limited, prices rise. But if supply outweighs demand, prices fall. Now, currencies work in a very similar fashion. The price of a currency is called the exchange rate, and it is usually driven by the demand and supply of two currencies. Now, this pairing of currencies like the rupee and the dollar is called a currency pair. If more people want the rupee, it appreciates, but if fewer people want it, it depreciates. It's as simple as that. Now, here is where some people tend to get confused. See, when the rupee depreciates, you would think that its value drops, and that is true for sure, but it does not mean that the number that you see goes down. In fact, it goes up and rises. So basically, when you hear that the rupee has moved from say 80 rupees per $1 to 84 rupees per $1, that is actually depreciation and not really appreciation. Basically, long story short, when the rupee depreciates, fewer people are interested in holding it and more people are after dollars. And that is why if they were earlier willing to give 80 rupees for $1, now they are willing to pay as much as 84 rupees for exactly $1 again. Now coming back to the main question, why has the rupee hit 84 rupees for every $1? See, there are two major factors that are driving an imbalance which is causing this. The first one is foreign portfolio investors pulling money out of Indian stocks, and the second one is the rising price of crude oil. Let me start with FPIs first. See, FPI investments are often called hot money because they move in and out of markets very quickly. When these investors pull money out of Indian equities, they sell off stocks, get paid in Indian rupees, and then convert those Indian rupees into US dollars to take their money elsewhere. Now, this increases the supply of rupees in the market, which puts downward pressure on the currency. The second reason, like I mentioned, is oil. See, India is one of the largest importers of crude oil. We spend about 150 billion US dollars every year on it. So when oil prices rise, India needs more dollars to keep up with its demand because oil is traded in US dollars. Therefore, Indian companies and the government have to exchange more rupees for dollars, which further ends up weakening the rupee. Now, with that out of the way, the next biggest question is, what exactly does this depreciation really mean for you, me, and the economy? Let me explain. See, when the rupee depreciates, exports become cheaper for foreign buyers, which is great news for industries that rely heavily on exports like textiles, IT services, pharmaceuticals, and automobiles. But on the other hand, imports become more expensive, which is bad news for industries like crude oil, which rely heavily on imported goods or raw materials. Now, since India imports most of its oil and oil is priced in dollars like I mentioned, a weaker rupee makes oil more expensive and therefore it increases costs for sectors like transportation, chemicals, and energy. Then there are everyday goods like electronics and machinery, many of which are imported or rely on imported components. Now, as the rupee weakens, these goods become more pricey, which leads to the next big issue, which is inflation. See, as imports become more and more expensive, the price of goods that depend on those imports goes up for obvious reasons. This fuels inflation, meaning everything from fuel to consumer electronics costs more and more. Rising prices eventually erode people's purchasing power, which makes it harder to maintain the same standard of living. Yes, the government and the central bank can step in and manage inflation, usually by raising interest rates, but that has a flip side as well. It can slow down economic growth, which creates a very tricky balancing act here. Lastly, there's also the impact on investment and debt. See, a depreciating currency tends to usually scare off foreign investors because their returns, when they're converted back into US dollars or their own currencies, end up shrinking. This can lead to capital flight where investors pull their money out of India, adding even more pressure on the rupee in return. Depreciation also makes foreign debt more expensive. So if the government or companies have borrowed in dollars, they now need more rupees to pay back the same loans. So this increases the cost of servicing foreign debt, which adds further strain on our economy. So to sum all of it up, a weaker rupee might help exporters, but it makes imports more expensive. It flares up inflation and increases risks for foreign investments. So it is a mixed bag and the effects ripple across the entire economy. Whether you're buying fuel, managing a business, or investing in the market, everyone feels the impact of a depreciating rupee. And that is why it matters. Moving on to the next story, let's talk about how the Indian government wants to help shipping companies. The Indian government is considering funding a protection and indemnity or P&I insurance entity. See, P&I insurance is essentially what ship owners use in order to protect themselves from a variety of costly risks at sea. This could be anything from accidents that damage other ships to oil spills, crew injuries, or even lost cargo. And this is very important because in case something goes wrong, currently the ship owner is legally required to cover the damages or fines, and that is exactly where P&I insurance comes in handy. And here is what it means for Indian ship owners. And right now, Indian ship owners have to go to international P&I clubs to get this kind of insurance. These clubs are basically a group of ship owners who pool in their money together to share the risk of these major liabilities. But the thing with P&I insurance is that it covers the kind of big, unpredictable incidents that regular marine insurance will not even touch, like environmental disasters or huge legal claims from accidents. These international P&I clubs have been around for over 100 years and they have dominated the global market. The largest ones, like the International Group of P&I clubs, actually insure 90% of the world's shipping tonnage. So almost every ship moving goods across the world has its risk covered by these very clubs. Whenever something serious happens, like a collision or a major pollution incident, these clubs make sure that ship owners have the financial protection to deal with it. But the thing is, for Indian ship owners, relying on these international clubs is very, very expensive. Premiums are especially high for ships that sail through risky areas like the Middle East or Russia, and this has led to the Indian government considering setting up their own P&I entity. More than a year ago, India's Finance Minister Nirmala Sitharaman hinted at the idea of creating a P&I insurance club within our country, India. But nothing really happened at that time, partly because setting up something like this is very, very complicated. You can't just form a club and start pooling money. You need the right regulatory approvals and legal structures, which India currently does not have in place. And that is why the government is now considering putting in some seed money to get things moving. They're even considering amending the Insurance Act to allow the creation of Mutual Insurance Association, which is the type of P&I clubs which already exist internationally. The idea would be to kickstart the process with government investment and then invite private companies and insurers to pitch in as well. But the question really is, does it really matter if Indian ship owners are already insured by international P&I clubs? See, it all comes down to control and cost. Indian ship owners are today paying very, very high premiums to foreign clubs, especially when they operate in dangerous regions. If India had its own P&I club, the government believes it could reduce those costs for Indian shipping companies and keep more money within our country. It is also about having more control over the insurance process rather than just relying on foreign entities. And beyond cost savings also, there is a bigger goal. The Indian government is very keen on developing its domestic shipping industry, and having a homegrown P&I club is a very, very key step towards having that. The Indian government's idea is to start very small and then gradually expand to cover export-import cargo and even international shipping. Now, of course, there are challenges. For one, insurers do not have much experience in handling this type of complex marine insurance. So there is a learning curve ahead for all of us. Second, therefore, the government is considering partnering with international players, even existing P&I clubs, to tap into their expertise and share their financial burden. Now, I know if you're not a ship owner, you're probably thinking that this is a very niche issue to even care about, but there is a bigger picture here. See, India is trying to strengthen its maritime industry and reduce its reliance on foreign services. Shipping is a very, very crucial part of global trade, and building more domestic capabilities, whether it's in insurance or shipbuilding, could really boost India's position in global supply chain. For now, Indian ship owners will continue paying these international P&I premiums, but if this plan takes off, it could lead to a very, very big shift in how Indian ships are insured. Indian ships will have much more control and will pay lower costs. Moving on to the third and the final story of the day, let's talk about TCS's latest quarterly results. See, recently TCS or Tata Consultancy Services released their results for the second quarter of FY 2025. Now, these results showcase some growth areas as well as some challenges that could affect profitability moving forward. Now, considering that TCS is the largest IT services company by revenue in India, its results usually show how the industry is moving overall. So, as investors, it is very important for us to keep a tab on what's happening, and in this story, that's exactly what we look at. I'll discuss TCS's revenue growth, geographical performance, push into new technologies like generative AI, sector by sector trends, workforce dynamics, and the overall financial outlook. I promise I'll try to keep it short, simple, and easy to understand. Let me first start with the revenue and financial performance of TCS. TCS reported revenues of 642.6 billion Indian rupees this quarter, and that is pretty much in line with what most people expected. This is a great sign in itself, especially considering the difficult economic environment that businesses are dealing with globally right now. But on the other hand, TCS's earnings before interest and taxes, or EBIT margin, which is basically a measure of profitability, slipped a little bit. It dropped 60 basis points to 24.1%. By the way, over here to give you an idea, 1 basis point is 1/100th of a percent. So 60 basis points basically means a 0.6% drop in profitability. And this drop was mostly because of higher third-party costs tied to large-scale transformation projects. Essentially, these big projects are costing them more, and that is squeezing profits. Now, these margin pressures are not expected to disappear right away, so it could take some time before we see an improvement here. In the short term, though, this might show up on TCS's profitability. The company's leadership says that they are cautiously optimistic. They expect things to improve gradually, but they're also realistic about the current economic uncertainty. The plan involves tightening costs and putting more emphasis on new technologies like generative AI. The TCS management sees generative AI as a major growth opportunity over the long term. So in the intermediate future, TCS may need to ride a bit of a rough patch, but looking further ahead, the hope is that their bet on AI could pay off very well. With that said, let's take a look at TCS's performance across different regions. Now, some areas here did well, while others were a little lagging. I'll give you a very quick breakdown. North America, which is TCS's largest market, saw a small decline of 2.1% year-on-year in constant currency terms. This suggests that clients in the region are being a little bit cautious with their spending, possibly holding off some big investments due to the economic uncertainties there. The UK, on the other hand, posted a growth rate of 4.6% year-on-year thanks to strong demand for digital transformation there. Businesses in the UK are investing in modernizing their systems as part of a trend. Even emerging markets like India, Middle East, and Africa performed pretty well. TCS has been capitalizing on local opportunities in these very regions, and it seems to be paying off well for them. Overall, it shows that while regions like the US and emerging markets are doing well, North America, which is the company's biggest market, remains a little bit of a concern. As an investor, this is something to watch closely because client spending in North America will be a key for TCS going forward. Moving next, as I briefly touched upon earlier, one of the most talked part about TCS's strategy this time is its momentum in AI projects. TCS saw its client engagements in the AI space double from 275 in quarter 1 to 600 in quarter 2, which is quite a significant jump. But what is even more impressive is that 86 of these projects actually went live this quarter compared to just 8 in the previous quarter. So by the looks of it, business are betting heavily on AI, and TCS is helping them integrate these solutions into their operations. So this shift could be a major growth engine for TCS. With global demand for AI increasing rapidly, it could be one of the company's key growth drivers moving forward. That said, let's look at TCS from a sector-specific point of view. See, TCS performance here showed some variability. Some sectors did much better than the others did. BFSI, which stands for Banking, Financial Services and Insurance, showed signs of recovery, particularly in the region of North America. Now, this is very important because BFSI is a huge part of TCS's business. Energy resources saw a strong growth, and they were up 7% year-on-year, driven by ongoing investments in digital solutions. Coming to healthcare, it faced some challenges, but these are mostly specific to individual clients. The company is expecting things to stabilize here in the coming few quarters. Telecom, on the other hand, remained weak, and clients are now focusing more on projects that can guarantee a solid return or investment or ROI rather than experimenting with newer initiatives. So all in all, for investors, while BFSI's recovery is a good sign, it is clear that not all sectors are back on solid ground yet. A full recovery across industries might take a little more time for TCS. On the workforce part, TCS added 5,726 employees this quarter, which brought its total headcount to 6,12,724 people. Now, this hiring is because TCS wants to strengthen its capabilities in areas like AI and digital transformation. Now, while we're looking at hiring, it is also important to look at attrition, which is the rate at which employees leave. This number rose slightly to 12.3% for TCS. Now, even though it is an increase, it is still within manageable limits. For a company of TCS's size, keeping talent stable is very, very key to maintaining project continuity and staying competitive in the market. So to summarize, TCS's management hinted that as global economic conditions improve, we could see a shift towards more discretionary spending from clients, meaning they will have more freedom to invest in big transformative projects. For now though, the deal pipeline remains very stable, but the real challenge will be converting these opportunities into actual projects. Let's now move on to the final section, which is the news tidbits. First, in the first half of 2024, UPI transactions surged by 52%, reaching a massive 78.97 billion. This sharp rise shows how digital micropayments are becoming the norm in India, so to speak. UPI is steadily taking over the payments ecosystem. Second, Air India has placed an order for 85 more airplanes from Airbus, which continues its aggressive fleet expansion. Air India is ramping up its efforts to stay competitive in India's massive aviation market, while Airbus is still struggling with supply chain issues. Third, AMD, which is a chip manufacturer, has launched its new MI325X AI chip. Despite this, the company's share took a hit due to concerns over demand. AMD faces very tough competition from Nvidia and Intel, which are both well established in the AI chip market. Fourth, rising commodity costs combined with weaker rupee are pushing up prices for cars, electronics, and appliances across the country. Companies like Maruti Suzuki and smaller electronic brands are increasing prices by 3 to 7% to cope up with higher input costs. Fifth and the final one, Good Glam Group is selling some of its brands, including Organic Harvest and Sirona, as financial pressures increase. The company's rapid expansion has led to cash flow issues, and buyers like Mama Earth and Nykaa are showing some interest in buying out these brands. That's all the news and stories I have for you today. I hope you found value in this episode. This is Anurag signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.